What's next for markets?
I'm Michael Kantrowitz, Chief Investment Strategist at Piper Sandler, where I lead the portfolio strategy team, recently ranked #1 on Wall Street in the 2024 All-America Institutional Investor Research Survey. I'm joined by Stephen Gregory, Head of Quantitative Research at Piper Sandler.
Hello, Michael. We are 1 week into September. Kids are back to school. And despite what is typically a seasonally bad month for the market, things are looking pretty good. Market's doing all right, and risk on leadership continues to ride this Goldilocks narrative.
Yeah, there's been a lot of talk about the fall seasonality backdrop for equities not being very good. And, I think we started off the month with the down day. We had a down day this recent Friday on payrolls, but, I think the market's still up for the month. And even last week, stocks were up despite a lot of that volatility.
Yeah, I think all the size and style boxes are up so far for the month. Not a bad start, considering the concerns from a technical perspective coming into it. But it's been pretty amazing what we've seen in markets over the last 3 months. It's been a pretty good year. We're double-digit returns on the market. And especially with the data point on Friday, this optimal macro backdrop continues to play out, and investors continue to rally risk on positioning behind that. Been pretty impressive.
Yeah. So what are you seeing underneath the market from a factor perspective? What's it telling you? Most people, they look at the S&P, they look at the Russell 2000, the NASDAQ, the Mag 7 stocks. And, we look at that, but we get a lot more granular in the weeds of factor performance to help corroborate what's going on in the market. So what are you seeing since April, I guess?
It's been pretty interesting. For the first time in a couple of years now, you've seen sustained risk on higher beta, your more classic recovery leadership. You had the initial pop in lower quality, most shorted, negative earnings companies. But since then, you've seen that kind of taper off, which is typical of a market bounce off of a drawdown. And you're seeing these higher beta value names outperform. And that's coming at the expense of what has been the winners, those momentum names that were the highly profitable, super high quality trades that had worked for 3.5 years now.
Yeah, it seems that, if you listen too much to the news, you would think there was a lot more volatility in the markets. I mean, it seems like every day, whatever the Mag 7 does, you get all these headlines that kind of overstate what's going on. If you look at the index right now, the Mag 7, and we're a tick off an all-time high. But if you look at some of the headlines today, and you had some of those big stocks down on Friday, it's like Armageddon's coming.
It's so tough these days because you have that secular story of AI that is focused on these mega names. And they skew a lot of the headline pictures of what's going on in the overall index, and makes it even tougher to understand where positioning really is, which once again is why we love factors. That continues to be a scenario that we've done for 20 years now, focused on factors as a better barometer of what investors are really doing. And the market seems to be continuing to reward that kind of analysis, because you've had the skew in sectors where one name drove the entire sector and skewed what sectors were doing. And now you have the Mag 7 and these mega cap names skewing the overall market picture. So it's become even harder to understand what's going on.
So how big now are the largest 10 names in the S&P 500?
It's just shy of 40%. I think it's 39 and change. And it's pretty incredible. That's the biggest weight you've ever seen out of the top 10 names. And their return is higher than you've ever seen out of the top 10 names. So their contribution to the overall market and skewing the return picture has never been bigger.
It is pretty extraordinary. Typically, even if you have names that are enormously large, just think of like ExxonMobil, Walmart. Those are not stocks that tend to be super volatile and go up 100% in a 6-month period. So even in the past, where you've had some really large names, they weren't super highly volatile. So the contribution to the return of the index was big, but it wasn't as crazy as we're seeing today, because now you're getting big size times big volatility equals extraordinary contribution. And that's a good thing, or it could be a bad thing, as many people are increasingly concerned about.
Yeah, it's pretty crazy. You think of these mega names of the past, like Exxon, Walmart, and JP Morgan, and all of those names. When they were the largest names in the index, they never moved like what you're seeing today. Pretty amazing.
So markets are up, but the last few months, really underneath the surface, it's been even a bigger move, if you will. Yeah, the market's up a lot, but it's been led by high beta names, which is not unusual. Like you said, in a period where the market's rebounding, fears around tariffs, inflation, recession are going away. But, interestingly, one of the things that you and I have been talking about for the last couple of years now is the idea of narrative volatility, and how particularly you see it in the long end of the curve. We've gone back and forth between periods of investors worrying about inflation and yields moving up, which I would say, we were pretty much there a couple months ago. The 10-year was around 450, and people were worried about inflation, and a couple data points on employment, and we're at 410, the 2 years pretty much near a new cycle low. People are talking about maybe getting 50 basis points of a rate cut in September, and obviously worries around recession with the softness in employment. We had a negative number. I think it was June now after its second revision. So there is a negative NFP print. How trustworthy that data is and how significant that signal is, who knows? But there's certainly plenty of data that corroborates that the employment backdrop is slowing. But yeah, here we are now in September, and we're back to the narrative that, the 10-year is going down a lot. The Fed's going to cut a lot. Maybe we're going to recession, and every employment data point is growing in its impact on sentiment in the markets.
And inflation's under control, and all of these macro concerns are not an issue at the moment.
So we'll see. We're getting this week, we're on September 11th. We'll be getting CPI for the month of August. So the question is, are we going to end this week with the same view, low bond yields and 50 basis points of a potential 50 basis points? Not likely, but a potential in the September meeting, or are we going to have an inflation data point that, several people have flagged that there's upside risk from tariffs, and see a backup in yields this week, which would just be another leg of the roller coaster for investors, and perhaps even bringing back that stagflation fear? I'm kind of leaning somewhat in that direction, partially because I don't think the economy is falling apart, number one. Two, we continue to see, some sustained pricing pressure in a lot of the past months' PMI readings. The services PMI and the ISM is still upper 60s. Manufacturing has come down a little bit, but it's still in the low 60s. And we've certainly seen slowly building impacts from tariffs, which perhaps they're just kind of rolling into the data rather than hitting the data sharply. The good news is that there's plenty of offsets on inflation. So I don't think investors should get overly concerned around inflation, because, we've got the housing backdrop, which is going to continue to pressure rents lower. We've got really low oil prices still. So, there aren't too many periods in time where investors are sustainably worried about inflation at a time where oil is very low. But we have gone really to one end of the spectrum with regards to that view on where rates are going, and not being worried about inflation and now being worried about employment. So I'm not saying we're going to see some really nasty inflation data and investors should get all worried about it, and 2022 is returning, nothing like that at all. But the crowd seems to be all on one side of the boat. So it does pose some volatility.
Potentially a little over their skis.
Potential for a surprise.
Absolutely. We've definitely run pretty far, pretty fast, and markets do tend to over extrapolate. With your view on the markets and the economic data, are we going to start seeing a little bit better data out of housing?
Well, that's a big question. And, the irony here in this cycle, which I think is not only unique because it's another cycle and every cycle is a little unique, but what really makes this cycle unique compared to anything in the last 30, almost 40 years, is that the inflation shock we had from 2022 has really, in a way, changed the reaction function and the impact of sentiment with respect to how markets and investors are viewing interest rates and inflation. And so, in other words, we've had many periods in the last year and a half, 2 years, where we had this bad news is good backdrop. And that is simply because bad news, meaning weak economic activity data, was viewed as a good thing because it helped allay the fears around inflation. If you're not worried about inflation, bad news is bad news. And that's, most of your career and my career, that was the case. And this backdrop is definitely different. We saw that in 2024, unemployment went up for 4 months, and basically 90% of that period, the markets were going up because investors were cheering lower rates and the potential for the Fed to cut. We're getting a little bit more of that today. Again, markets pretty much near all-time highs today, valuations back up to the highest levels in years, credit spreads down to the lowest levels in years. So the market's not pricing in any risk. And if anything, as you just pointed out, the leadership in the market has been going to the beta buffet and just, filling up your plate a couple times. I think the market's on portion number 6 now. So what's going to be interesting is to figure out where's the tipping point on employment data where bad does become bad, because I don't think we're quite there. I mean, even last week on Friday, you mentioned housing and asked me about housing. Home builder stocks were up and a lot of the rate sensitive names were up. So we're kind of in this backdrop where to get the economy more broadly improving, you need lower rates, and to get lower rates, certainly in a quick way, and to get the Fed to cut more consistently, that's only going to come from weaker employment data. So we've had that. So in a way, you could be backward looking and say, well, oh my God, the employment data is weakening and I'm worried about a recession. But at the same time, that is sowing the seeds of better housing data and just generally a better economy into 2026. That's the way the business cycle has always worked. The fact that this has been this slowdown has meant that, we haven't had any major shocks. And that's meant that we're getting closer and closer now to the data more broadly improving. And so in the month of September so far, we've had leading indicators, I'm specifically talking about PMIs, that were generally better. Bloomberg, one of the things we track is the leading indicator surprise index. That's been going up since April, and it does a pretty good job at explaining what the market's doing. At the same time, we've had softer employment data and negative surprises from employment, and that's brought down bond yields. So if you're putting all of that together, we've had better leading indicators. That's coincided with pretty broadly improving earnings estimates. Doesn't sound like a recession. And lower interest rates. So we're kind of in this sweet spot here, because you need lower rates, in my opinion, to get the economy and earnings to see stronger breath. You don't want too much of it, but we're not quite there yet, in my opinion.
And that's the threading the economic needle we've been seeing, is you've seen the employment data slowing, but not dropping. And that's allowed these underlying forces to potentially move us forward and be the next leg of the rally. But the big thing you brought up is earnings. Earnings with valuations at these levels, you'd likely have to see earnings do a lot of the lifting on the next leg.
Yeah. I mean, there's a case for valuations to certainly stay high, and that's kind of our view. There's a case for valuations to expand even more, which would likely come about if we don't see unemployment go up that much, and at the same time, don't see inflation pressures build or rebuild that much. That kind of keeps us in this sweet spot. And our view is that we're going to more or less be in that type of environment, that we're not going to see employment move up sharply enough to really hit the economy more broadly. And though we do expect to continue to see some softness in employment, and on the inflation side, again, there's reason to believe that pockets of inflation will keep heating up from tariffs, but again, there's offsets there. So you're not really seeing any kind of really clear, broad-based inflation problem or employment problem. And in this backdrop where investors have been worried about inflation and higher rates, and certainly with the housing backdrop needing lower rates, there's an argument to be made that we're in this, again, Goldilocks pocket right now. And perhaps we could stay there. Everyone thinks of hearing soft employment. They think of recession. They think of 2000. They think of 2007. And, those coincided with some massive economic shocks. You had some really big tightening cycle in 1999, oil prices, many people kind of forget this, but in mid-99, the Fed started hiking aggressively. Oil prices went up to a 20-year high. The 10-year went up. And then, of course, we started seeing employment fall apart late in 2000, and the markets were already on their decline. And you had obviously a massive overinvestment in CapEx with respect to the internet. So there's some concern around that today with AI, but that doesn't mean that's the right playbook, because that's a sample of one, and this is not 2000. So again, we think that parts of the economy are really strong and they're going to remain strong. Parts of the economy are weak, but they're giving you a path to lower rates and a better housing backdrop. And ultimately, I think this is setting up for broader economy and broader earnings backdrop heading into 2026, which is a pretty good thing, particularly with valuations as high as they are, unlikely to contribute as much as they have in the last 3 years to the upside of the markets. And so on valuations, obviously, there's not so many people that aren't concerned around valuations because pretty much every metric under the sun shows you we're at pretty extreme levels, but we should be at pretty extreme levels. If you think about the drivers of valuation, okay, earnings expectations, okay, those have been improving. Inflation's fairly low right now. It's come down from 9%. Oil prices, they were high in 2022. Now they're really low. Profit margins of the S&P 500 are at record highs. So you throw those variables into a model and they're not going to tell you what level the PE should be explicitly, but they will certainly lead to a very high level. So I'm not really concerned at all about valuation. I would be more concerned if we saw a real crack in employment or a real spike in interest rates or inflation. And as I said just earlier, I don't think that's a huge sustained risk. Not to say that there won't be some volatility and pullbacks when we get data or periods of excitement with respect to the bond market like we did last week. But, I think the economy is in this like really interesting, perfect reflexive backdrop. And it reminds me, and this is, I got to give credit to Danny Kirsch, who heads up the Piper Sandler options desk, of something he sent around in a note. I think it was 2018 or late 17, early 18, when the VIX was really low. And he made reference to a Simpsons episode where they were Burns goes to the doctor and the doctor says, "You're the sickest man in America. You've got every single disease. And in fact, we've discovered new diseases, but Burns looks like the picture of health." And the doctor says, "Well, what's interesting is all of these diseases you have are perfectly offsetting one another. So you're fine." It's a really funny clip. If anyone hasn't seen that, pull it up on YouTube. It's pretty good. But in a way, I think the economy and somewhat the stock market is kind of in that backdrop. Like, okay, maybe we have a quote disease, that employment softening, but that's helping to cure the inflation disease and the fear of higher rates disease. Sure, there's concerns around the deficit, but we've got a tax bill that just passed that has some pro-cyclical earnings benefits. So really, and this has been, why the last few years have been so debated and polarized, because there are risks on both sides of the equation. And thus far, it's hard to argue they have not perfectly offset because markets are at all-time highs, valuations are there, and credit spreads are super low.
So as we're keeping an eye on these diseases, and you mentioned there's a lot of reasons to be optimistic about the economy and markets today, wrap it up, conclusion. What are the key points to be watching that you're going to be focused on in the weeks ahead?
Yeah, so obviously, in the near term in the market, is all very, what have you done for me lately? So we're going to get CPI this week, and that'll determine probably how the market does this week and whether or not we see any narrative shifting and a backup or a further rally in interest rates, which compounds the sentiment of what the Fed's going to do. So, again, each one of these data points has these magnified sentiment and market impacts because things are so path dependent in the near term. But looking out more broadly, there are many signs because interest rates haven't gone up in 2 years. The 10-year's been more or less flat and it's at the low end of the range. Same thing with the 2-year. The Fed has cut 100 basis points already and is very likely to cut in September. You are now getting green shoots on things that lead the economy, which the market doesn't really price in because it's so far ahead of the data, but it helps understand where some of the data are headed down the road. So while everyone right now is very focused on employment, which of course in our HOPE framework is the caboose of the cycle, the lagging indicator, I don't think anyone's going to disagree with the fact that employment's lagging. You've got data that are leading of employment like PMIs. And hey, this month we saw the services PMI, the new orders was in the mid 50s. The ISM manufacturing went above 50. And more importantly, data sets that lead those that help us understand the direction, the path they're going to be traveling over the next several quarters, generally pointing up. So this doesn't seem like any kind of recent backdrop of pre-recession. We certainly don't have tightening in the pipeline. Oil prices are low, rates are low. Sure, we can get some inflation from tariffs, but that in and of itself is not going to cause a recession, I don't think. And on the positive end, well, everything I just said is with low oil and low rates is signaling that 2026 is going to look better on top of the pro-cyclical fiscal policies. So I guess investors have to decide, are they going to be forward-looking or backward-looking? But don't forget, and you have to, I guess, come up with your view of the world and how the markets react. Is the market going to be forward-looking or backward-looking? And I think, in the last month, we saw leading indicators improve, but weaker employment data. But again, the markets are up over the last month, and the leadership suggests that investors are taking on more risk, not less risk. So still constructive, further upside for equities, but probably going to see more volatility in the next several weeks because it does seem like everyone is on one side of the boat. And something that's clearly been a constant in the last 3 years, when sentiment gets one-sided as it is today, generally it's been a good idea to kind of think about taking the other side of that. And perhaps that means that bond yields back up if we get some maybe better data or a little bit warmer inflation data. But I don't think, again, that's a big bear case for equities here.
So the outlook ahead is good, but you could see a little volatility in the near term as we settle into the next leg of the market cycle. I love it, Michael. Thanks as always. Very informative.
All right, Steve. Have a good week.
We hope you enjoyed today's episode of What's Next for Markets. You can subscribe to the show on Apple, Spotify, YouTube, or wherever you get your podcasts. Be sure to follow Michael on X at Michael Cantro. If you like the show, please let us know by leaving a positive review. The preceding commentary is not financial advice. You should always seek appropriate financial advice from a professional financial advisor in your state. You should not consider this as a substitute for these services. Piper Sandler does and seeks to do business with companies covered in its research commentary or coverage. As a result, investors should be aware that the firm may have a conflict of interest that could affect the objectivity of this commentary. Investors should consider this commentary as only a single factor in making their investment decisions. For full disclosure information, visit www.pipersandler.com/researchdisclosures.